Hey, baby, shout out to you. I'll see you.
I don't want to be a player no more. But let me say this though. This is why charts don't always tell the whole story. It can be a little bit misleading because with Troy, this is a good example of this.
Mm-hmm.
So Troy had referenced something. So in 2017, in 2007, 2007.
2007.
I'm like,
you need
what?
that IV. It's okay.
2007. Yeah.
All you need for some energy right now is to think about the person who talked about the AB. The energy gonna shoot up. Let's go.
2007, XLF was $30.
Mm-hmm.
And today it's $33.
Mm-hmm.
Mhm.
That's discouraging because that's saying in 15 years, it only went up $3, right? But that's not the whole story because in 2007, obviously that
It was a
was
split. Yeah.
the biggest
The crash. Yeah.
collapse in American
Right after
history and it went from $30 to $7. It's actually a little less, like
$4.77. Yeah.
Right.
So that was something that nobody could have seen coming. It was the worst event in American history with the banking system. But since then, so if you look at what it's done since then, since 2009, it's 371% to now. So in 12 years, it's actually increased almost 400%.
Yeah.
Mm-hmm.
So once again, the chart is a little
But
misleading.
then go back in the chart then, right? Because
I
if
did.
you look, so then
I did.
The ETF it opened at $19, right?
In 1999.
This in 1999. So it got up to, like you said, it got up to $27 or $30.
30.
And
$30.87.
$30.80.
It fell apart. Yeah.
Then it fell apart. And so what I'm saying is, like, if you look at where it was at in its peak, in 15 years, yeah, obviously it is a huge collapse. But in that 15-year span, it's gotten back to where the peak was.
Mm-hmm.
Yeah,
and the other part is stop buying at the top of the market. This is the part why I rant. If the stock is worth $40, stop buying at 39 and being like, somebody in Discord told me it was going to 94. If that's the case, why would I tell you that? Shout out Charlemagne. Charlemagne will never text us and be like, yo, I got a $600 million deal, but this is how you thwart the deal and get it for yourself. It's not going to happen. It is not going to happen. Like, you guys just have to wait. And this is the part that I love for business owners. Once you learn the stock market, and this is a tip that most people don't know, when you study these companies and ETFs and see how they're accurately ran, there's ideas that you can take from them and put into your business. But also when you run a business, you can see if that ETF or stock is being ran well, and you can see what the projections are. So now if quantitative easing is there and the interest rate environment is low and we go through a crash, you shouldn't have been buying at $30 or $35 or $28 in XLF back in 2006 and 7. And people were telling you about the housing crisis that was coming.
Mm-hmm.
Most just didn't listen, i.e. my take on Netflix, i.e. my take on Meta versus Facebook. Hello to everyone that might not be there soon.
Yeah,
i.e. my take on other industries. Stop buying at high prices and stop believing the hype of what you're being told in the media space, and you'll be good.
Yeah, so some of those factors that you just said could have caused the run up to 30. You know what I'm saying? Like, obviously, Matt used to call it the Wild Wild West, but when you're talking about interest rates, when you talk about how banks are making money, this could have been some of the reasons why it was at 19, and obviously it had a run up over those first 7 years up until 30, and then obviously the financial collapse. But also on the side of the ETF is that a lot of the allocations could change. So
absolutely, that's the key point.
That's key point too. So they could have added companies that were like, hey, we see that this is going to be profitable, or we're going to add more of an allocation to a JP Morgan, or we're going to allow Berkshire to have more of an allocation of this ETF. So that rise could have happened because allocations were taken out, right? Banks that were here before and financial institutions that were here before no longer exist.
Yeah. And always think
that's the whole point of ETF.
That's what I'm saying.
But I'm just saying, historically, it has done well, because it started in 1999 with $19 and it got to $30 in 2007. So in 7 years, that's 57% increase.
That's a great return. You don't have to think about.
That's an excellent return. Like I said, it had, this probably won't happen again, but it dropped. But then since then, it's up 400%. So as an investment, I mean, I don't have a horse in the race.
I mean,
but
2020 dropped to $17.
2020. Yeah.
As a long-term investment, it's done well.
Mm-hmm.
Yeah, I just got to figure out what type of investor you're going to be, though. That's what
I'm just saying it's done extremely well. What kind of investor would you not like? It's difficult for me to say why.
Somebody might have. So here's why. Somebody might have bought it at 30, right, and sold it.
Well,
right.
Somebody could have bought Bitcoin at 60, and so
that's what I'm saying. You have
especially when I told you not to.
Yeah, just to decide what type of investor you're going to be.
But I'm just saying to say that it hasn't really done well, or
who said that?
You said the returns haven't really been too great.
I didn't say that.
What'd you say?
I said if you look at the history of it over the time, right, it was at 30, and now it's at this number. If we're talking about something that is like, if we're looking for growth ETFs, right now.
Put in chat if Troy said it hadn't done well. I don't remember.
Yeah, I don't remember saying that.
So
you're saying that.
Alluding to it, you're saying it's at 30 and it's at 30 now. That's saying that it hasn't done well, right?
No, I'm talking about the growth over the 15 years.
Yeah,
but let's look at that. If it's still at break even.
But if something was 30, 15 years ago and it's 30 now,
is that break even?
That's common sense that it hasn't done well.
Well, no, you're technically losing money through inflation. Yeah, you lose the money through inflation.
Is that doing well or not, Ian? Is that doing well or not? No. If an investment is 30, 15 years ago and 30 now, is that doing well?
No.
It's 33 now.
That's not doing well.
Yeah, you're saying that.
But I'm just saying that's why I said charts can be misleading.
Okay.
Charts can be misleading, but this is
in what way? Yeah, because charts only calculate the price. It doesn't tell you all the information.
It doesn't tell you the historical. It doesn't tell you historical data, and it doesn't tell you things that's happened. Even Apple, you could look at time frames where Apple's chart could be something that you can actually look at and say that this isn't a good investment. Bitcoin.
That's what I also just
who would say that though?
Huh?
I'll be the Apple Avenger. Who would say that?
Who would say what? That
Apple's not a good investment.
Well, if you look at it, so all right, let's look at this then. So if you look
producing, I see you.
I mean,
this is what you do.
Yes, it is. So all right, Apple came out in 1984.
Yep.
And it was 11 cents. And
it was flat for a long, maybe 7 years or something.
In 1994, let's say in 1990, it was 32 cents. So somebody could have looked and said, okay, yeah, it's went up in that time frame, but in almost a decade, that's not something that we really look at like it's going to be a world-changing company that we should invest money in.
Mm-hmm.
That's like, now if you look at it from 2000 and 2009 when it was $3 to now where it's $162, that's completely different. But it took time. It took a long time.
Every great investment takes time. How long is Pump and Build and Revolt? And it's not even nowhere near its peak.
Yeah.
Everyone wants 7,000% return in 1 year.
But it's like, so like I said, look at this. I don't know if you can see this, but if you look at your Apple, because everybody has an Apple phone. If you look at the Apple phone and you look at the stocks, look at Apple, AAPL. If you look at it, it looks like a cardiac sign. It's flat for a long time, almost 20 years. It's flat, and then it just starts going crazy. So this isn't historically a chart that somebody will look at.
But so here's the thing: when you looked at it in 1984, are you saying that this is a growth stock? It's not going to be considered one. Just
there weren't many growth stocks back then because at the time,
right? That's what I'm saying. So just looking at it from that standpoint, you're not saying like, yo, if we're putting a category of growth stocks, this is not going to fit in.
All I'm saying is that technical analysis and fundamental analysis has to be taken into consideration.
Yeah, you have to have both. And global macro first.
You can't always look at charts. Sometimes charts don't tell the full story. Sometimes a company could be a good company, good leadership, and not have the greatest chart. Or it could be the inverse. It could be having a great chart and the leadership could be bad at that time. And you could see that, okay, the landscape is changing. So even though the chart might look good, this might not be something that
that's why people have to go do their research or tune in.
It's not an argument. I'm just saying. It's not an argument.
Number one.
I'm saying who's arguing that what you're saying.
But there's a lot of people that it's an educational show. So the thing is to give people as much education as possible. So some people are new to investing and they might not fully understand things and they just hear things from different people. So the whole point is just to provide people with education.
But I'll say that too. You guys have to stop listening to so many people.
Yeah, but part of the
and I'm gonna always say this too.
But let me just say this, Ian. Part of the education is not to assume. So we can't just assume that people automatically know everything. We have to help them out and give our take. And ultimately, it's our opinion, right? But it's like, I'm just...
No matter facts. I got to say that for the record.
So it's important. It's important for people to understand that there's multiple sides to invest in, and that's going to help them because they're not just going to look at one particular thing as like, this is the only thing that I should be looking at.
I think it's a mistake to look at too many people. That's like having 7 wives or 7 husbands. Like, you guys can do whatever you choose to do. But if a person is not investing or trading full time, which I do and have been prior even to the show, how can they tell you how to get rich or success from a space if they're not full time at it themselves? That's why I never comment on anything. Man, LeBron should have faded away in the fourth quarter. I'm like, I don't have the capability that LeBron has. Life is a lot easier, especially here on the show, because it's the only show that gives you prices. That is technically a liability for my career and brand in doing so. But I knew, because I know my stuff based on me buying, when these prices hit and it works, put yes in chat if I made you money. I'm going to be real. I never even seen the show do that in no space. Put yes in chat if I made you money.
This that Red Panda Anthem. Ian, what's up? This that Red Panda Anthem. Red Panda, what's good? Red Panda Anthem. Whole clip going up. I know they can't stand it.